$38 trillion. Take a moment. Really try to feel the weight of that number. If you stacked 38 trillion $1 bills, flat, one on top of the other, that stack would not reach the moon. It would pass the moon. It would travel beyond the moon, reaching more than 4 million miles into space, 16 times the distance from Earth to the moon, and still not be done. That is the United States national debt. Now here's what they never taught you in school. For most of modern history, economists and politicians treated government debt like a scoreboard, a number, an abstraction. They said, it's money we owe ourselves. They said, we can grow our way out of it. They said, don't worry about it. That era is over. Today, the U.S. debt is no longer a scoreboard. It is a predator. And it is quietly consuming the American economy, one interest payment at a time. In this video, we're going to show you exactly how the United States government plans to escape this debt. Not by paying it back, not by cutting spending, but by making it disappear, slowly, silently, and at your expense. This is the story of the greatest wealth transfer in modern history. And most people have no idea it's already happening. Let's start with a number that should terrify every American citizen. In 2024, the United States government spent over $1 trillion just on interest. Not on roads, not on the military, not on schools or hospitals, just on the cost of carrying the debt. For the first time in American history, interest payments on the national debt now exceed the entire defense budget of the United States. Let that register. The most powerful military nation in the history of the world is now paying more money to its creditors than it spends protecting its borders. That is not a budget line. That is a national emergency, and it gets worse. Imagine a family. Decent income, decent house, but they've run up $500,000 in credit card debt over 20 years. Every month, the minimum payment alone eats their paycheck. You'd tell them to cut the Netflix, cancel the gym, stop eating out. Pay it down. Simple. Except the United States government is not a household. And this is where conventional wisdom breaks down completely. When a government cuts spending in a crisis, it doesn't just tighten its own belt. It removes money from the entire economy. Businesses lose contracts, workers lose jobs, tax revenues collapse, and paradoxically, the deficit gets worse. This is the debt spiral. You borrow to survive, interest grows. You borrow more, interest grows faster, repeat. The Congressional Budget Office now projects that if nothing changes, interest payments alone will consume 40% of all federal revenue within the next decade. 40 cents of every tax dollar. Before a single road is built, a single soldier is paid, a single check is mailed to a retiree. So the debt cannot be ignored. That's established. The question is, what are they actually going to do about it? When a sovereign nation is drowning in debt, history offers exactly 3 escape routes. Option 1, austerity, raise taxes dramatically, slash government spending to the bone, pay the debt down the hard way. On paper, this works. In practice, it is political suicide. We saw what austerity did to Greece in the 2010s. Unemployment hit 27%. Youth unemployment hit 60%. The country collapsed into a decade of misery and still needed multiple bailouts. Now imagine trying to impose that on the United States, a nation of 330 million people accustomed to entitlements, subsidies, and social programs built over a century. No elected politician in Washington will touch that. Option 1 is politically locked. Option 2, explicit default. Simply announce that America cannot or will not repay its debts. This would be a financial apocalypse. The US dollar is the world's reserve currency. American Treasury bonds are the foundation of the global financial system, held as collateral by banks, pension funds, and central banks in nearly every country on Earth. A US default would not just crash Wall Street. It would trigger a global financial system collapse, the likes of which we have never seen. The 2008 financial crisis would look like a minor correction. Option 2 is financially catastrophic, which leaves only one option. The soft default, don't refuse to pay. Pay in full, but pay in dollars that are worth less. Don't raise taxes visibly, impose an invisible tax through inflation. Don't cut spending dramatically, just make sure the economy grows slower than you print money. This is the path of least resistance. And it is the path the United States is already on. The only debate in Washington is how fast to walk it. Financial repression. The phrase sounds academic. The reality is anything but. Financial repression is a set of government policies specifically designed to transfer wealth from the private sector, from savers, from workers, from the middle class, to the state. And the United States has deployed 3 specific tools to execute this transfer. The first tool is the captive buyer. After the 2008 financial crisis, the government passed sweeping financial regulations. Dodd-Frank in the United States, Basel III internationally. Officially, these were about preventing another crash, protecting consumers, limiting risk. And they did do that, partly. But buried inside these regulations was something else. Rules requiring banks, insurance companies, and pension funds to hold large quantities of what the regulations defined as safe assets, and specifically designating U.S. Treasury bonds as the safest assets in existence. Think about what that means. The government, which is the one issuing the debt and needs buyers for it, also gets to write the rules about what financial institutions must buy. This is not a free market for government debt. This is a captive market. Banks are legally incentivized, effectively compelled, to absorb U.S. Treasuries regardless of the interest rate they offer. Regardless of the risk, the government has created its own guaranteed customer base. And that customer base has no real choice but to keep buying, even as the debt grows, and even as yields remain artificially low. The second tool is the broken compass, and you encounter it every time you check the price of eggs. Here's a question. When the government tells you inflation is 3%, do you believe it? Look at your grocery bill from 3 years ago. Look at your rent, your car insurance, your utilities. Does 3% feel right? The Consumer Price Index, the CPI, is the government's official inflation gauge, and it has been quietly engineered over decades to understate the true cost of living. Two mechanisms are at work. The first is substitution bias. The CPI assumes that when the price of one thing goes up, you switch to something cheaper. If beef gets expensive, they assume you eat chicken. If chicken gets expensive, they assume you eat beans. The basket of goods you're measured against is a constantly moving target, always adjusted downward. The second mechanism is hedonic adjustment. This is where economists reduce the measured price of a product because it has allegedly improved. Your new laptop costs more than the old one, but because it's faster, the statisticians say it's actually cheaper in quality-adjusted terms. Your rent went up 40% in 5 years. Your health insurance went up 60%. Your groceries went up 30%. But the official CPI says inflation is manageable. This is not a measurement error. This is statistical sleight of hand, and it has massive direct consequences for the debt. When the government issues inflation-linked bonds, and when Social Security payments are adjusted for inflation, they use the CPI. Understate inflation, and you pay out less. You claw back real value, silently, legally. And most people never connect the dots. This is a monetary mirage, and you are living inside it. The third tool is the most powerful of all, and it operates through an institution that most Americans believe is independent. The Federal Reserve is supposed to be independent. Its mandate is to control inflation and maximize employment, not to manage the national debt. In theory. In practice, we are now in a regime that economists call fiscal dominance. This is when the size of the government's debt becomes so large that it begins to override the central bank's ability to make independent monetary decisions. So what does this mean for you? What do you do when the rules of money are being rewritten in real time? The first shift you need to make is mental. The era of saving as a wealth strategy is over, not because discipline doesn't matter, because the instrument you're saving in, the dollar, is being deliberately devalued. Every year you hold cash, you are losing ground. Not because of bad luck, because of policy. The wealthy understand this. They do not save, they own. They own real assets, land, equities, commodities, businesses, things whose value adjusts upward as the currency is debased. In every major inflationary episode in history, Weimar Germany, post-war Britain, 1970s America, the people who survived financially were those who understood that capital preservation requires asset ownership, not currency accumulation. The new game is not saving, it is asset survival. But there is one more piece to this puzzle, and it may be the most consequential development in the history of modern finance. Central bank digital currencies, CBDCs. Over 130 countries, representing 98% of global GDP, are currently researching or developing a central bank digital currency. China has already launched one. The European Central Bank is in advanced trials. The United States Federal Reserve has been actively studying a digital dollar. Proponents say this is about modernizing payments, financial inclusion, not efficiency. Those are not lies, but they are not the full picture. A CBDC is programmable money. Every transaction is recorded. Every wallet is known. The issuer, the central bank, can set parameters on how, when, where, and on what the money can be spent. Money can be given expiry dates. Spending can be restricted by category. In a crisis, accounts can be frozen or funds redirected with total immediacy. Now consider In a world where the government needs to erase trillions in debt through inflation, and where financial repression requires that savers cannot escape into hard assets, what would programmable digital money allow? It would allow the government to make inflation inescapable, to prevent capital flight, to ensure that every dollar of your savings participates in the slow erosion, by design, without exception, with no exit. This is not speculation. This is the logical conclusion of fiscal dominance carried to its endpoint. The soft default requires that you cannot opt out. A CBDC fully implemented would make that impossible. Whether that future arrives depends on choices being made right now, in legislative chambers and central bank boardrooms, that most of the public is not even aware of. And that is precisely why conversations like this one matter. Let me be direct with you. The story we have told today is not a conspiracy theory. Every mechanism we described, financial repression, CPI manipulation, fiscal dominance, the Cantillon effect, these are documented, discussed, and in many cases celebrated in academic economics and policy circles. They just don't make the 6 o'clock news. The soft default is not coming, it is here. It has been underway in various forms since at least 2008. The question is not whether your savings are being eroded. The question is whether you understand how, and what, if anything, you intend to do about it. Knowledge is not neutrality. Understanding a system is the first step to navigating it. If this video reached you, if it changed how you see what's happening, I ask only one thing. Keep the signal alive. Share this with someone who needs to hear it. Subscribe, because the next video goes somewhere even darker. In 1933, President Franklin Roosevelt signed Executive Order 6102. With a single stroke of the pen, he made it illegal for American citizens to own gold. He ordered them to surrender their coins, their bars, their certificates to the government, not as a suggestion, as law, with criminal penalties for noncompliance. Why? What was the government so afraid of? What does a government do when it needs total control of its citizens' money? And they won't give it willingly.